Today, after having successfully achieved financial freedom through my passionate pursuit of lifelong learning, I can happily say that I'm a better investor because I'm a lifelong learner, and I'm a better lifelong learner because I'm an investor.
It's my pleasure to introduce to everyone here Mr. Gautam Baid, CFA. He's the author of international bestseller, The Jaws of Compounding, and he's a portfolio manager at an SEC-registered investment advisor based in Salt Lake City, Utah. And previously, he served at the Mumbai, London, and Hong Kong offices of Citigroup, Deutsche Bank, uh, as senior analyst in the healthcare investment banking teams. Mr. Baid is a CFA charter holder and a member of CFA Institute. And in 2018 and 19, he was profiled in Morningstar's Learn from the Masters series. It's my pleasure to invite Mr. Baid on the show. We'll be discussing his book, Choice of Compounding, and our viewers will have the link to this masterful book. So, Mr. Baid, it's my pleasure to have you on the show, sir. Thank you for coming.
Thank you, Siddharth. It is a pleasure to be here.
And I'd like to begin with the title of your book. And there are a number of concepts in this book, both with regards to investing and life. Why did compounding specifically stick out to you as, what the whole book should be built around?
Sure. So in the first chapter of the book, I write that today, after having successfully achieved financial freedom through my passionate pursuit of lifelong learning, I can happily say that I'm a better investor because I'm a lifelong learner, and I'm a better lifelong learner because I'm an investor. The principles emphasized throughout the book power the lifelong compounding journey of a value investor. At the same time, the learnings are not restricted to only about investing. This is because compounding does not apply only to money. Social and intellectual capital also compound. Investing in yourself, in your relationships, and in your understanding of the world pays massive dividends over time. And basically, all the great things in life come from compounding, and that is why I've written about multiple aspects of compounding in my book, including compounding positive thoughts, compounding good habits, compounding good health, compounding wealth, compounding knowledge, and compounding goodwill. So that in essence is the reason for choosing the title of the book as The Joys of Compounding.
Mm-hmm. Wonderful. And you talk about compounding, and you alluded to this in this question as well, in both from a investing perspective and also just in general life principles. So could you expand on as to how it works in both those senses, maybe?
Sure. Charlie Munger has said that the game of life is the game of everlasting learning. He has also said that those who keep learning will keep rising in life. Now, these to me were profound words, and I embrace them as a way of life. You see, the body is limited in ways that the mind is not. By the time most people turn 40 years old, their bodies begin to deteriorate. But there is no limit to the amount of growth and development that our minds can sustain. Reading keeps our minds alive and growing, and that is why we should all inculcate a healthy reading habit. Books are truly life changing once you have developed the habit of reading every day while watching your every thought. The neural connections that compound through the effort will make you an entirely new person after a few years. Buffett and Munger estimate that they spend 80% of their daily lives reading or thinking about what they've read. Therein lies the secret to becoming smarter. The way to achieve success in life is to learn constantly. Once, when asked about the secrets to his success, Warren Buffett held up stacks of paper and said, read 500 pages like this every day. That's how knowledge works. It builds up over time like compound interest. Albert Einstein had reportedly said that compound interest is the most powerful force in the entire universe. So, what happens when you apply such a powerful force to knowledge building? You become a learning machine. Even after achieving so much enormous success, Buffett still reads for many hours every day, and he often attributes much of his success to his good reading habit. Reading allows him to learn the lessons of others. The more you read, the more you will build your mental repertoire. And incrementally, the knowledge you add to your mental stockpile grows over time as it combines with everything else that you put in there. This is compounding in action, and it works with knowledge in much the same way as it does with interest. Eventually, when faced with new, challenging, or ambiguous situations, you will be able to draw on this dynamic in a repository, or what Munger calls the lattice work of mental models. Mental models are an explanation of how things work, what variables matter in a given situation, and how they interact with each other. In short, mental models are how we make sense of the world.
Absolutely. And yeah, Mr. Buffett is famous for this concept of inner scorecard. Could you expand on that a little bit? You also mentioned this in your book.
Sure. The inner scorecard is the inner set of criteria and standards by which a person measures himself. The outer scorecard, on the other hand, is an external comparative picture of self-worth predicated upon the judgment of others. An outer scorecard, which many people have, asks, what do other people think of me? Will they judge me by the clothes I wear, or the car I drive, or the way I look? But the inner scorecard, which is much more important, asks, am I treating other people fairly? Am I doing the right thing? Is this working for me as an individual? Basically, many people end up living someone else's life throughout their life, and instead of actually living what they truly believe in. If you know what you did was right and fair, then the criticism of others should be considered and analyzed to see whether it truly has any merit, but it should never be given permission to belittle whatever you're trying to achieve. Self Self-respect beats social approval every time, and you should live your life based on internal principles, not external validation. We are not perfect, neither should we pretend to be, but we can always endeavor to become the best version of ourselves.
Wonderful. And you also speak about philanthropy and good karma. Could you expand on how does that affect an individual's life over time, and what are maybe the unforeseen benefits of indulging in those two activities?
Blessed is the investor who can use his wealth to do good for others. We're able to create wealth only with the help of others, so giving back should also be a part of our planning. And you can derive a great deal of happiness and personal fulfillment from the act of making a positive difference in other people's lives. Givers greatly enjoy seeing the wealth that they have created during their lifetimes coming back to life again by enabling good things to happen for certain targeted causes that carry significant meaning to them. As the saying goes, you cannot take it with you. And givers derive a lot of joy from converting their financial resources into actions and values that they truly care about. One of America's richest individuals, John D. Rockefeller, his charitable giving began at the age of 16 during his first job as a clerk, when his giving exceeded 6% of his income. And by the time John D. Rockefeller turned 20 years old, his charitable giving exceeded 10% of his income. As Rockefeller's wealth grew, so did his giving. And all of us can learn a valuable lesson from Rockefeller's life, that it is never too early to start giving and helping others. It doesn't matter if you have a lot to give or just a small amount to give. Something happens to your heart when you share with others, something that changes you for the better. And to make a difference in someone's life, you do not have to be brilliant, rich, or perfect. You just need to care. I did not want to deprive myself of the happiness from giving. So during my initial years in the United States, even when I was earning minimum wages as a front desk hotel clerk in San Francisco, I began donating to small sums to local charities, as low as only $10 in some cases, when that was all that I could afford at the time. So it's all about the intention and about the direction. That is what really matters in the long run, because ultimately compounding will take care of the rest. Over time, as my wealth has grown, so have my charitable contributions, and it gives me a lot of happiness to put a smile on the faces of the less privileged. I was delighted when a dear friend and I jointly won the bidding auction in November 2018 for the annual charity lunch with Monish Pabrai, the entire proceeds of which would go to the Dakshana Foundation.
Mhm.
Writing about and sharing my life's biggest learnings was my way of giving back to the investing community, from whom I've gotten to learn so much over the years. Our goodwill compounds when we share with others, and we should act as a funnel of knowledge, not a sponge. As Charlie Munger has so beautifully said, the best thing a human being can do is to help another human being know more. In life, the winners also lose occasionally, but those who help others win can never lose. So always help others rise. This is how goodwill compounds over time. And it is my personal belief, Siddharth, that there is always this particular feedback loop, positive feedback loop when you engage in the smallest of good acts for others. The acts tend to take a full circle and return back to bless you with good things in your life. And karma is like a big snowball. Let me illustrate with the help of a personal example. 3 years ago, when I self-published The Joys of Compounding and sold it for zero profit to enable affordable access to all the readers, the only intention was to help others, nothing else. I'd never expected the book to become so popular, but when you help others without expecting anything in return in an unconditional manner, the universe works in such a way so as to reward you back multiple times over. During May 2019, I was at Creighton University in Omaha, Nebraska, during the Berkshire Hathaway annual meeting weekend. And lo and behold, Miles Thompson of Columbia Business School Publishing came over and offered me a publishing contract with them. And the rest is history. The Joys of Compounding went on to become an international bestseller in 5 countries globally.
Well, absolutely. And from what I've heard, Mr. Buffett loved it as well. And
Yes, he did.
and it really is a fantastic book. And so, and the great thing is it's sort of, it gets put into these life principles as we've discussed, and also investing, which is what I would like to move into now. Value investing has been almost around for 100 years now. In some form, it was actually started with Mr. John Maynard Keynes. I think he started pretty much around the same time as Mr. Ben Graham back in the 30s. So it's been almost 100 years. Why do you think it has endured the test of time? Why are there more value investors than ever before? And why does it work? Really?
It works because the principle of buying something for less than what it is worth will never get old. Phil Fisher had very rightly said that the stock market is filled with individuals who know the price of everything but the value of nothing. Price is known to everyone in the market, but value is understood by only a select few. Stock prices randomly fluctuate every day, sometimes wildly on either side, whereas underlying business value changes very slowly. And therein lies the opportunity for us as value investors. Focusing on what is moving is part of our evolutionary instincts. And that is why most market participants focus on stock prices, which keep bobbing up and down, rather than business values, which change very slowly. And capitalizing on others' desire to avoid downside volatility is what makes value investing work. As Joel Greenblatt perfectly said, value investing works, but value investing does not work all of the time. And that is why value investing works.
Absolutely. And moving on to your investment process. You mentioned that you incorporate checklists in your investing, much like Mr. Pabrai does. How does that help you make higher quality decisions? And if, without taking names, maybe you can walk us through an example of where using a checklist allowed you to make a better quality decision than if you weren't using one.
A prudent investor never purchases ownership in a company without conducting the necessary due diligence. Study the company and its competitors, both listed and unlisted, from the company website, filings, and information on the internet. After that, study the last 10 years annual reports, proxy statements, notes and schedules to the financial accounts, the management discussion and analysis sections. Within that, check for changes in management tone and changes in industry outlook, and also monitor the recent trends in insider shareholding. After that, proceed to study the following parameters in checklist fashion: income statement analysis, balance sheet analysis, cash flow analysis, operating efficiency analysis, return ratio analysis, management quality analysis, and a psychological checklist of the standard causes of human misjudgment. All of these 7 different checklists have been elaborated in details with their sub items in my book. And it is very important to note that the ideal checklist is subjective and it varies from individual to individual. And an investor should have a clear understanding of what he or she is trying to achieve in each investment situation. For example, the primary checklist items when evaluating shorter term opportunities like demergers, commodities, and cyclicals is very different from the primary checklist items you would look at when evaluating longer term opportunities like high quality secular growth businesses, where quality of business and quality of management is the most important. So that basically summarizes the entire things you should look for when using checklists.
You mentioned psychological biases that prevent all of us from making rational decisions. Could you maybe walk us through an example of where a psychological bias could have pushed you, or identifying your own bias helped you make a better investment decision?
So in my book, I've talked about my investment in a company called HEG Limited in India during 2017, in which I had made more than 270% returns in less than 5 months on a big allocation. What happened was I had exited the stock on 1st February 2018, and just 1 month after the date of my sale, in March 2018, I came across a news report which mentioned that the graphite electrode prices, graphite electrodes are HEG's main product, the graphite electrode prices were actually going up further per metric ton, and that the supply situation was becoming even more tighter in the graphite electrodes market. When the facts change your mind. I immediately re-entered HEG Limited with this time with half the percentage allocation that I had at the time of my previous exit. And in one single go, I was able to conquer a host of personal biases that had affected me since the beginning of my investment career, namely anchoring bias, commitment and consistency bias, and status quo bias. I finally, and this is why the HEG investment will always be very special to me, because it was a big step forward in my evolution towards rationality. I finally exited the second investment in HEG in August 2018 at a handsome profit, resulting in a total compounded profit of more than 350% in less than 1 year on this company's stock from my initial invested capital. So this is what happens when you are actually able to compound your capital multiple times over while controlling your biases. As Benjamin Graham has said, the investor's worst enemy is often himself. If we are just aware of these biases and diligently follow our checklists, every time we make an investment decision, it can greatly minimize the errors. Honest mistakes and errors will occur throughout the life of an investor, but just having good sound knowledge of financial history and human psychology helps us minimize them to a large extent.
Absolutely. And you also mentioned spin-offs as a great hunting ground for value investors. You, I think, cite Mr. Babra, who I think visited Mr. Munger, and he was told that you have to look at spin-offs and 2 other ideas that he gave him there. Look at other investors, what they're doing, and cannibals. So spin-offs specifically, how do you go about finding them? And, without maybe giving any specifics, how would you think about spin-offs?
Because spin-offs receive little attention from Wall Street in USA and Dalal Street in India, they are less well understood by investors and thus become mispriced. And all this bodes well for future returns. At a 2009 speech at the Ben Graham Center for Investing, Seth Klarman had said, spin-offs are an interesting place to look for opportunities because there is a natural constituency of sellers and not a natural constituency of buyers. A very profitable spin-off opportunity often occurs when very promising but small size company is demerged from a large size parent and is listed with some residual institutional shareholding. During its initial weeks and months of trading, you will often observe forced selling by those institutional shareholders who are not allowed to hold this new stock in their portfolios because of their rigid institutional mandates, such as being allowed to invest in companies only above a certain market cap, or being allowed to invest in companies only from certain sectors or industries in case of sectoral mutual funds. Now, whenever someone sells in desperation, they tend to sell cheap. And as a buyer, I love to be on the other side of such trades in which the opposite party is being forced to liquidate his holdings at any price, irrespective of underlying value. The time to buy is when those institutions are in a hurry to dump their shares at any particular price. And this has happened multiple times in India. I can state multiple examples. One past example was Solar Active Pharma few years ago. Last year it was Aarti Surfactants in August 2020, and very recently in March 2021 we had Jubilant Ingrevia. So these kind of opportunities keep coming now and then, and the key is to identify the quality of the business and only participate in the in such spin-offs and demergers where the underlying business quality is pretty good, but it's just being dumped and because of short-term technical reasons. There is another kind of spin-off opportunity in which the sum of the parts is more than that of the whole, at times a lot more. This happens when a loss-making business or subsidiary is spun off from the parent. And in this case, what happens is that the parent company's net profit, valuation multiple, and market cap go up because of enhanced profitability and balance sheet strength. And at the same time, the loss-making business gets some market cap based on market cap to sales ratio or enterprise value to EBITDA. Now, again, here I will mention three separate case studies, one from the past, one from the present, and I'll also share two future opportunities of this kind of a demerger. So in the past, when you had a company called Suven Life in India, which basically demerged its highly profitable CRAMS, contract research and manufacturing business, into a company called Suven Pharma. Once Suven Pharma was separated from the loss-making drug discovery business of Suven Life, it immediately became a multi-bagger within a few quarters last year, because it was basically earlier what was happening. You had a combination of a loss-making business, which was the drug discovery business, and the highly profitable cash generative CRAMS business inside one listed entity. The moment both of them separated, investors, from their holdings in both the stocks as a whole made a lot of money. So that was a past example. Now I'll give you a current example. There is a company in India known as Tips Industries, which has two businesses. One is a highly lucrative cash generating music streaming business, and it also has a loss-making film production business. And just earlier this month, they have announced the demerger of their loss-making film production business, which will get completed in a few quarters' time. Once the loss-making business is demerged from Tips Industries, the remaining highly lucrative music streaming business, it will basically become a pure play music streaming business. And that time investors stand to make very handsome gains once the demerger process is complete. Now I'll mention two future opportunities in demergers in India, which look very interesting. So next year, Strides Pharmaceuticals is going to demerge its vaccine business, Stelis, which is currently a loss-making business. And Aurobindo Pharma is going to demerge its very profitable and lucrative injectables business. So investors in India should definitely keep these two demerger opportunities on the radar for next year.
Absolutely. That's very fascinating information. Thank you for sharing it with us. And if we were to come back to the US market maybe for a second, the interest rates are at a rock bottom. I mean, lowest they've ever been in the history of this country, really. How would you go about selecting a discount rate in your valuations? How would you even go about normalizing?
Even though the current low interest environment may continue for a long time globally, I still like to be conservative in my estimates and assumptions when valuing companies. The S&P 500's long-term annual return of 9.7% during the 20th century can be taken as a reasonable proxy as the cost of capital for valuing companies. Professor Bruce Greenwald in his value investing class at Columbia used to instruct his students, just use 10%. It is close enough and it makes the math easy. So, this particular figure of 10% can be taken as the starting estimate for the cost of capital. And investors in countries outside the US can use the long-term market returns of their respective countries as the initial starting estimate for the cost of capital. And this figure can then be revised up or down depending on the individual company's risk characteristics.
Yep, that actually I did ask Professor Greenwald that same question, and that's very similar to what he had to say himself. This is more of a macro question, I would say. What are your thoughts on India as a potential investment destination for both US and international investors? And we see there's obviously high organic growth, just the GDP growth being twice as high as that of the US economy, but also there's less competition. Do you think investors should transition, maybe look towards India in the future, in upcoming decades, maybe as a great place to maybe park their money?
So there is a saying which goes, no force on earth can stop an idea whose time has come. And India's time has arrived. It took India 60 years to reach its first $1 trillion in GDP, but it took just 7 years to reach the next trillion. And the upcoming consecutive trillions are expected to be achieved in much faster succession. I have a simple overarching belief which makes me joyfully average upwards in the great Indian businesses that I own, that over the coming few decades, trillions of dollars are going to be added to India's GDP. And if we simply assume that market cap to GDP, which is known as the Buffett indicator, remains around parity in the long run, one can just envision the kind of wealth creation that lies in store. Trillions of dollars. And the nation's best managed companies with proven ability to scale up their operations will capture the bulk of this upcoming wealth creation boom in India. It is my personal conviction and belief that all investors should definitely have some allocation of their personal portfolio in the Indian equities. One should simply not miss such a great long-term wealth creation opportunity.
Absolutely. And that's what we believe in as well. And we hope other people understand that opportunity. And speaking of opportunity, life is a series of opportunity costs. And could you speak about decision making, keeping this concept in mind?
So capital is finite and always carries an opportunity cost, which is what you can do with the next best alternative. And as investors, we should regularly review the estimate of the long-term return from all the holdings in our portfolio based on the current market price. If the estimate of the long-term expected return falls below the return expected from passive fixed income instruments, then it is time to sell that stock and replace that with a superior one. All too often, investors tend to fall in love with their holdings, especially if they have identified it after a lot of hard work and effort. And then they start engaging in lazy thinking and do not conduct a rigorous opportunity cost analysis on a regular basis. Every single dollar spends the same. And investors should strive to achieve the maximum bang for their buck from every single dollar invested. Use a very high hurdle rate when evaluating potential incoming opportunities. Always think in terms of opportunity costs.
One. And lastly, what are some of your favorite books and or resources that have made the biggest impact in your both professional and personal life?
So right up there would be Poor Charlie's Almanac, great book for investors and non-investors alike. I would also mention Peter Bevelin's book Seeking Wisdom, which is the finest book I've read on multidisciplinary thinking, as well as another book by Peter Bevelin titled All I Want to Know Is Where I'm Going to Die, So I'll Never Go There. It's the best book written on the theme of inversion. So these are the three books I would highly recommend to every investor to read.
Absolutely. Well, would like to thank you for taking the time out of your busy schedule and joining us and all our viewers. How can people maybe reach out to you? I mean, we'll obviously be publishing a few links to your resources, but are you on, maybe can people reach out on LinkedIn, other social media as well?
Sure. People can reach me through my book's website, thejoysofcompounding.com, and I can also be reached on LinkedIn and Twitter.
Absolutely. So thank you, Mr. Gautam Baid, for joining us. It was a pleasure having you on the show.
Thank you, Siddharth. This was fun.